Good morning, everyone, and welcome to another episode of Securities Lending Live with Pierpoint. So thanks very much for joining us. I've got my colleagues, John and Jeroen here, although for whatever reason, I can't see Jeroen at the moment.
No, I can't either, but good morning anyway.
Good morning, everyone, and hold on. I got a bit of background noise. So the objective of these events is really to discuss relevant topics and themes in securities lending, but also particularly to get people involved, right? So the reality is we've all attended conferences, and this year it's been a fantastic opportunity for people to get involved with virtual events. But still, it's not always easy to get questions in or to participate in the discussion. And the thing I like about the events that we've had over the past few weeks is that it's not just asking questions. We've been getting quite a lot of good feedback from people that are actually watching it. These events are live and they're open to anyone, and we genuinely want you to put your comments and suggestions in. But look, as a starting point, we always have a competition here to see which location has the most viewers. So if I could just ask you to put into the comment box where you're watching from, I think that'll be interesting, or at least it will be to me. I don't know about everyone else, but there's usually a healthy competition between Kent and the Netherlands. So we'll see whether that carries on into another week. Now,
So
just
right, out of interest, are you now captured in a tier 3 zone?
I think I've been in a tier 3 zone for a while, and London and parts of Essex are in the UK now. So the way I look at it is top tier. You know, they're outperforming those areas. So again, well done to everyone that's in the top tier and not able to do anything as a result of that.
Here we are. Holland's already representing themselves.
That's it. We have the regulars. So Mike, good to see you, and Manny, glad you could join us again. And we're off now. But Drew, and I understand that there have been some tighter restrictions in the Netherlands as well.
Yeah, the funny thing, of course, is that the Dutch people don't go out on a massive booze night like the English people saw doing in Soho and all the usual drinking places. But we are back into a rather tight lockdown with schools closed, non-necessary shops closed. And most likely until the 19th of January. So I was a bit surprised that the UK let go of the restrictions a bit, but I understand that Bojo is turning on the screws again.
So, Jeroen, your Christmas period is the same restrictions apply?
It's +1 actually. So normal restrictions now is that you can invite 2 people. With Christmas, you can invite 3. So hey, happy days.
Well, listen, don't assume that the UK is static yet. I think there's going to be quite a lot of debate today as to whether they should narrow even the Christmas relief down further. So watch this space. And speaking of watching this space, I want to welcome Ludmilla from Dublin. I think you're our first viewer from Ireland. So thanks very much and welcome. And Sam, hello again to you, and Zoran. Good to see you, mate. Right.
Don't forget Reza. Huh? You're skipping the Dutch people.
No, you're right. I missed Reza. So look, there's actually a delay of about sort of 20 to 30 seconds between what you put in here, and it kind of scrolls up and down. So my apologies, Reza. You'll get first mention next time there, and the battle's on. So look, today, what we're going to talk about is a few things. Really, as we said, is this really the year from hell, and what's the outlook for next year? And so some of the things that we're going to be talking about today are inevitably the big movers and shakers of this year, which are SFTR and the short selling bans. Those are the two big impacts, I think, on the market, directly on the business. but we're also going to be talking about revenues as a reflection of those two events and other activities, and then some of the trends, looking at things like ESG and technology is sort of shaping where we are today, but importantly, driving where we will be in the future. So if you have questions or thoughts that you want to have answered, pop them into the post. What we actually do is we try to address as many of them as we can live, and those that we can't do live, we always respond to in the comments afterwards. So we'll get it addressed one way or another, and that might even be that we don't know the answer. So we haven't come across that yet, but I'm sure
that's a challenge.
Something. Yeah, look, I've when I do my training course, remember the old days when we would do live in-person training. I used to challenge people to ask me a question that I couldn't answer related to securities finance. And then I would challenge them to say, if you ask me a question and I give you the answer, how will you know if I really know the answer or I'm just feeding you something? So that's kind of the corollary to that. But look, maybe I could just ask my colleagues to introduce themselves. So John, over to you.
Good morning, John Arneson, consultancy lead for Pierpoint, 30 years in the securities finance industry, and looking forward to 30 more.
Oh, I can't say I'll say the same thing, but Jeroen Bakker, I'm the Benelux consulting lead at Pierpoint. I got 20 years, and I won't say I'm going to do another 20 years, but hey, you never know, right? Yeah, looking forward to our third session already. And for those of you out there, Merry Christmas already.
Yes, indeed.
Merry Christmas, happy holidays, joyous festive season.
Yes, yeah, let's be inclusive.
So look, actually, when you mentioned that, John, one of the big, most popular posts on LinkedIn over the past couple of weeks has actually been a post by someone who, Shay Rowbottom, who actually said, if you truly love what you do, you never really retire. What's your thinking on that?
Well, let me start with that. I mean, one thing I've learned over the years is that when I left BNP Paribas in end of January 18, because I decided to take a break, is that you never stop the desire to keep on learning or to be active. You've got to fill your time with something, and there's only so much time I could spend lying on Chewang Beach in Koh Samui or at my beach hut in Bournemouth. And I realized that I was incredibly busy with things that I enjoyed doing, but there's nothing like getting your teeth into something that you've always enjoyed doing and ultimately, preferably, being paid for. So I think to answer your question, Roy, that if you have a desire to learn, and the reason why this industry is so fascinating is that you can never know it all. And it's constantly changing. If you notice, every 5 years or so, it looks very different from the previous 5 years. And that's because things do change and it is dynamic. And therefore, I think that's how I look at I look at that. And if you enjoy what you're doing, and I certainly do, and I'm quite fascinated by it, that it isn't really particularly onerous.
Yeah, that's an interesting point. Jeroen, what about you? You don't want to have another 20 years in this business, apparently. So
I'm just doing my calculation, and that would be just before my retirement age. So maybe there's going to be another 20 years in this industry. But the bottom line is, what for me personally is that this industry, and of course I've been in the business for all my working career almost. But this industry, you meet such fascinating people and people that that trigger you, that learn you new things, that you can learn new things too. And I think that's where I've had my most joy in this industry, is with working with the people in this industry.
Yeah, and my own view on this is that I can't see myself ever retiring, to be honest. But what I do see myself doing is becoming a little bit more selective over time, and I think that's hopefully the luxury that is in front of us all. Listen, Sam, I just wanted to address your comment there. Did I just say that I knew it all? No, I don't think I did. I think what I said is, I can flim-flam some of the people to make them think I know everything some of the time. So I think that's the correct answer. But
Actually,
thanks for commenting.
Roy, I just saw that we have our first viewer from Italy. That's
Yep.
that's first.
Nicola, thank you very much for joining us. Appreciate that, from Milan. I hope I'm reading about all across Europe. I think that everything is getting tightened on as a result of coronavirus, just in the run up to hopefully vaccines starting to be available. So maybe it's just a few more weeks or months before things start to get back to normal. So John, maybe we can kind of jump into SFTR. Because that's been the seminal moment this year. I think that's the thing that fundamentally has had a profound impact on certainly the business in Europe, but potentially on everyone's business.
Undoubtedly. And when you think how long it was in the making, and I'm trying to think back when I first knew that we had an issue to address. And when I think I got to the grips of how detailed this was, it was kind of scary at the time. But this was many years in the making. And I think the impressive thing, looking backwards now, is the collaboration between different trade bodies to address some of the technical standards that came out and that no one ever really read unless you were really into it. But the reality was that if you look at the correspondence between trade bodies in the UK and around Europe, back to ESMA to seek clarification and to get that clarification, and then ultimately last year to seek a delay, which was approved, although you would argue that ESMA made its decision irrespective of that. It looked like it was such a well-coordinated event because it affected so many parts of the capital markets, and I think that is something that should be learnt and built upon. If you can collaborate with something that was horribly technical, when you think about it, the technical standards had no wiggle room in particular. And what they've done is really set the standards for standardization, which is a horrible sentence, I know, but you've now got a set of data that you have to adhere to and you have to work towards, and it's mandatory. Now, if you can take that and apply it to a non-mandatory situation, which I know we're going to come on and talk about, for example, how do we collaborate around CDM, given that no single body really owns that? I think will be interesting going forward. It looks like where we are.
Can you just CDM? What's that stand for, and why is it important?
The common domain model. I don't want to take any thunder away because I know we're probably going to talk about it later. But the common domain model is really about getting standardized messaging or processes that we can all use that look the same for certain functions. And it's something that we're going to certainly have to embrace at some point. If this market is ever to move with the rest of the world in terms of technology, that will be something important. But again,
sorry,
right,
maybe go back to SFTR. Yeah. Thanks for that.
So that's what I liked about SFTR, in that it sets the groundwork to working towards a common goal. The jury's out, I think, in terms of its success rate. And what I mean by that is that where are we now, December? So we're almost coming up for 5 months. We are in 5 months of data that's available. And it looks like the sort of acknowledgement rate from submissions from parties is high. I mean, it's certainly in the 90% range. The matching rates are also in the high 80s, low 90s from various organizations, which also looks like the work that was done by individual firms has been successful. But what I'm curious about is that there's a very low percentage matching rate for collateral, which I'll come on to that in a minute. When it comes to the reasons why things aren't matching, I think sometimes timing can be an issue between organizations. I think some firms are aggregating data when perhaps they shouldn't. For example, I read from a trade repository that it looks like an agent lender was breaking down the allocation to each of its underlying beneficial owners and giving it a UTI, whereas the borrower only knew one UTI, and therefore that will not match. And I'm sure that can't be. There has to be more than one organisation that's had that issue, and it must be. It's obviously being fixed as I speak. When it came to collateral, it looks like the reasons why things aren't reconciling. There's a lot of disagreement between nominal amounts and market prices and loan prices, when there's terms collateral prices. And they're all things that, again, I think need tweaking at the edges. Now, was this ever going to be 100% successful on day one? No. There's too much required in the fields that it was always going to be a work in progress to some extent. And even though I hate to say that, because I think if you've got something that you're working towards that is a regulatory standard, it should be pretty good on day one. But this thing isn't, and it probably could be a factor of sometimes I think the trade repositories may also be receiving data and interpreting it differently. For example, there's one that had a very high over-collateralization rate and one that had a very low collateralization rate. And this leans itself towards perhaps the way that they are receiving net exposure, which again, I think it's been worked out because that was happening in October, and by December, those rates were way, way down. So it looks like maybe the trade repositories are also learning as we went along. The messaging, the ISO messaging 2022 contains a lot of information, and one of the things I think we've learned is that any error in that message invalidates the entire message, and there's a lot of information that goes through that message. So that's again something that can lead to failure. So it looks like we've had a fairly successful go at this. I think the question will be is, if the error rates continue, especially on the collateralization side, and again, I didn't mention this, but LEIs is the single biggest reason why collateral fails. And we know that LEIs are an issue. I know that there was a paper out earlier this year that suggested that the industry itself should be seeking issuers to encourage them to get an LEI, which I totally disagree with. I think national regulators should be the drivers of that. But it's very hard to convince a Korean corporation to get an LEI if it doesn't need one, or it deems it doesn't need one in its existing business. So that will be an ongoing work in progress to some extent. To what extent will ESMA have tolerance for continued poor matching? I don't know. I think it's sensible to assume that at least a year's worth of data has to be received, reviewed. Patterns of failure has to come out of that analysis. So that would be a sensible thing to do at the end of at least 12 months. I think any earlier doesn't make a lot of sense. But one thing I'm fairly convinced about is that unlike CSDR, which is going through another consultation round, as you all know, particularly around the issue of mandatory buy-ins, I don't see that SFTR will be opened up for new scrutiny and consultation. I think the horse is bolted on this one, and I think it will be cleaning up some of the error messages, the error causes, maybe a consultation to some extent, or at least a discussion as to why they're happening. But I don't see any fundamental changes to this. But on the whole, what they do with the data, don't ask me. I'm sure it's very useful. I'm sure it has some patterns in it. The fact is, though, it was mandatory. It worked. It's hard, and it's heading in the right direction. But it's by far closed from its the requirement to be very high 90s compliant.
Right. So thanks. Yeah, and as I understand it, there is going to be some consultation in sort of Q2, but again, more feedback, not necessarily with a view to making any structural changes, because again, as you suggest, probably still too new and too fresh to really be making any sort of fundamental changes.
Yeah, I mean, I think, Roy, if they find common themes in terms of why certain errors are reoccurring, that would be a worthwhile debate. But I think the answer will be, well, find a solution, as opposed to we'll let you off the hook. I don't see that happening.
Yeah, and the data mining, I think, is the most interesting part of it. I think the people that have done best out of this are the sellers of supercomputers to regulatory agencies to crunch the data, as opposed to the regulators themselves or the market participants. I'm curious from people that are actually watching whether they think that SFTR has had a positive impact, a negative impact, or kind of been neutral on their business, or it's really just too soon to say. Because one of the things that we've certainly talked about and explored is the potential that this kind of standardization that you talked about, John, where you have, there's one methodology for reporting. We know that the life cycle events have to go down a certain pathway and be reported along the way, and then combining it with the common domain model, which again we'll come to later. But all of this standardization, then surely that creates an environment where automation can really be more effectively applied. What do you think about that? Both you, John, and then Jeroen, to you as well.
So I'll just briefly comment. Automation is everything. I just read a report in the FT this morning, or no, sorry, it was in FinExtra, about the fact that a certain Swiss bank is now looking at really employing robots for its trading. So these robots are going to basically create algorithms that are going to then create algorithms themselves, and that the human intervention of that is going to be somewhat null and void. Now, it had the image from iRobot on the front of the article, so it was slightly tongue in cheek. But without automation, how on earth are you ever going to achieve volume? And if you look at the businesses that have achieved that to a much higher extent than maybe securities finance, the FX market, for example, that is the only standard we can really aim for. Because if we're going to continue to drive cost out of the business in general, I don't know how you do it without that. Now, I do think there's a fair amount of automation already built in. But I think that the behind the scenes internally with individual firms, the processes are different. And that's the thing we're trying to work towards a standard. Those processes need to look the same as everybody else's. Otherwise, we won't be able to get to this common domain model. But I don't understand why anybody wouldn't want to throw resources at automation rather than resources at people.
That's a good point. Jeroen, anything to add to that?
Well, one of the things that I was hoping SFTR would bring along was the entire agency lending disclosure allocation model, which is broken, which has been broken for a number of years. And if you know your flows, if you know your allocation, which has to come through SFTR, then why do you still need ALD? So hopefully that is one of the things that will come out of SFTR. And of course, brokers and banks that are borrowing securities are screaming for that information, just to know who they're dealing with at the point of trade instead of knowing it 2 days later.
Yeah, so I think that's a great point. Although I would disagree that it's broken. You can't break something that was never actually fully functional in the first place. And I think since it was implemented in the first instance, the reality was it was never a perfect solution, right? It was a solution to a regulatory requirement, particularly in the US, but it was never a 100% solution. So I think the breakages just became more obvious over time and more widely accepted.
But in theory, right, SFTR does solve for that, because the information is there instantly when you book.
Yeah, but
whether you're sharing that information directly with the counterparty at the same time, I guess for the managed service it happens, but is it happening quick enough? Because I think, to your point, Jeroen, if you're a borrower, you need to know who your exposure is to now.
You do.
And in fact, it even drives the decision for whether to borrow or not, or at least ought to, depending on how RWAs, if they're calculated at the trade level, the desk level, or the business unit level.
Well, let's be honest. RWA calculation should be done on a trade level basis, and each trader or each initiator of a trade should know what their upfront costs are going to be, and therefore know whether or not the trade is viable, yes or no. But yeah, you're right. SFTR should provide that kind of information, but it is not being disclosed at the moment, and therefore we are still, relying on the entire ALD process to come up with the correct allocation.
I'd be interested to hear from the audience how they're approaching certainly from agent lenders, how they're approaching this, because you're right. It's only a question of time before you're going to have borrowers saying, "Look, you need to start giving up my name over the phone, or whatever communication you're using. I need to know now."
Yep, correct. And one of the things that you mentioned earlier as well, John, is that you were interested to know what the receiver of all the data, so the regulatory bodies, were doing with that data. And of course, the original objective was to find systemic risk in this kind of transaction. So, okay, fine. Now they have the data. The question is, how much systemic risk is allowed, and how do you reduce that systemic risk, and when are you going to act on it? So I'm interested to see what the regulatory bodies have to say on this as well.
Okay, so we'll leave that hanging. This is like a big cliffer. What are regulatory authorities going to say about agent lender disclosure? I'll tell you, or the data mining that they have at their fingertips. I think I know the answer, but watch for future episodes. Who knows when some information will drop. For anyone that's joined us in the last little while, and there's been several, why don't you just sign in, say hello, and tell us where you are coming from. As we move on to my favorite topic, is it my favorite topic, or is it the topic that gets the most feedback? Short selling and short selling bans. So look, the other thing that, in addition to SFTR, the much bigger sort of global issue was the imposition of short selling bans in a number of countries around the world. 3 of which are still in place, right? It's still in place in South Korea, Malaysia, and Indonesia. And in the case of South Korea in particular, I think that's amazing. I think the market's up 90+% since the depths of the market in March, yet the short selling bans are still going to be in place for another 3 months. And on top of that, we see this kind of conflicting view. And I posted this story recently, where some regulators in Korea want to encourage retail investors to get involved in short selling, which, is definitely a trend. There is no question that retail participation, both on the lending side and on the short selling borrowing side, is increasing without a doubt. And so it's not uncharacteristic for a market like Korea to include that. And there is quite a big community of day traders in Korea. So it's good to see that, but it seems kind of oddly juxtaposed with saying retail investors should get involved with something that at the moment, even institutional investors are being stopped from. So that seems strange. Now look, I started my first blog post in 2008, in August of 2008, the month before Lehman defaulted, because it had been a year of regulators and the public and the press having a go at short sellers. And I thought we just needed a little bit of fight back, and someone needed to be arguing the case. And I thought, if no one else was dumb enough to do it, I would. So I've been arguing this for a long time. And I think the interesting thing about this year is that it was only really, 10 countries. And so it wasn't the 30 countries from last time. And I think that really reflects the acceptance and acknowledgement by many regulators that, number one, short selling is a part of a properly functioning market. And number two, that maybe it was a mistake last time and it actually hurt liquidity. And I think there's been a number of academic studies that said market liquidity was hurt, but also spreads. So sellers of stock weren't getting the price that they should get, and buyers of stock were paying more than they should get because of short selling bans. And I think, reluctantly, maybe regulators have taken it to heart. So let me just say hello to Rob. Thanks for joining us, and Gregor from Slovenia.
That's
So
not a tick for Holland.
yeah, I wanted to skip over that. But there you go. This is so Sam has asked a really good question. How would you present the argument on short selling to a private wealth client looking to sign up to SBL? In my experience, they're not interested in the generic conversation, but one at a specific stock level. And look, I think every investor, and this includes me, when I buy a stock, I have belief in that stock, and I don't necessarily want to put it in the hands of a short seller. But if you look at the Robinhood investor, who often gets targeted as a holder of Tesla, they have made a fortune this year in terms of their Tesla performance, and any incremental money from securities lending is kind of immaterial in that sense, but it's incremental, irrespective. And the way that I frame this always is that what you have to remember, anytime you buy a stock or a bond, you're expressing the opposite view of the seller. Because if the seller thought the price would still be going up, they'd be holding on to it. They wouldn't be selling it to you. You wouldn't have an opportunity to buy it unless you had a different opinion from someone else. So structuring any portfolio means that you have a different view. And I would always suggest to people that you don't buy anything until you have a view that it's actually a good investment that's appropriate for you. And just because someone has a different opinion from you doesn't necessarily mean you're wrong and they're right, or vice versa. And so I think markets are really just a collection of opinions. And if you have that opinion and you can generate extra income from that, then why wouldn't you do that? Now, in the question of materiality comes into play as well. No one investor's position is going to really have a material impact on the price. And I think we've got a great example of that with the fact that just over a year ago, the government, what's it called? What's GPIF? The Government Pension Investment Fund, which is the Japanese government pension fund, they announced that they were going to stop lending their securities, their equities, carry on with fixed income, but stop lending their equities in the market. And while that got a lot of headlines, and I think that was part of the reason that they made the announcement, was to get the focus on them. I don't think it had a really material impact. Were there recalls? Inevitably. Was liquidity tightened in some names? Probably. Did it cause short squeezes that had a lasting or disruptive effect on the market? I think the answer to that's no. So if large global institutions like that don't impact it, then I don't see how an individual customer can. But look, these things do affect people's points of view. And I think one of the things, and we'll come to this later as well on ESG, is that, it's well known that there are kind of behind the scenes some other investors in the ETF space, for instance, that are re-examining securities lending and whether that's consistent with ESG. So we'll come back to that on the ESG topic. So
Yeah,
let me just sum up, John. My favorite blog posts, I always get lots of feedback on them. They always cause lots of emotion and debate. My argument's always been 400 years ago, they were talking about it as being unethical the first time around. 400 years from now, I'm sure we'll still be having that same debate. John, over to you.
No, I was just going to say that the thing with the GPIF is that they made no statement as to, or they didn't align their decision with anything to do with short selling. If anything, they quoted certain governance principles that they wanted to strengthen, but I think that was worth noting.
Yeah, that's a good point. As you say, their issue was transparency. Who was going to be the end borrower of the securities, and to what purpose were they doing that? Look, if that's what people want, I think that is never going to happen. I just can't see an end hedge fund disclosing via their prime broker what their purpose is in executing a trade. And even if they did, what's to stop them from saying, well, that was our purpose when we initially did it, but then we changed our mind on the trade and then we allocated it to that. So I think that's really, I just can't see that. And that's if a hedge fund would be willing to disclose. And maybe the activists would, but I think it's unlikely otherwise. So, Jeroen, I'm curious whether in your sort of trading activity, and as either a borrower or a lender, whether you saw the actual impact of these short selling bans and sort of feedback from users on their end.
Well, if we look at the 2020 securities lending revenue, and this is all public data, right? So this is published by IHS Markit, and I've just taken their data. And you look at the overall revenue year to date. So it's December. So let's say year to date till November, end of November, is down 10%. That is predominantly in Asia, which is down 24%, and in the EMEA region, which is down 90%. So that is a huge chunk of revenue gone compared to the year before. And of course, then you're looking at reasons why is that? Well, of course, there were short selling bans in Europe, especially the southern part of Europe had a short selling ban, and as well, of course, in Asia there was a short selling ban. So yes, I do think that the short sell ban had a negative impact on the securities lending revenue. However, there were also additional reasons. Of course, the market value dropped massively in Q2, and that of course has a negative impact on the revenue, as the revenue is calculated on the value. 2020 also saw, I would say, less specials compared to 2019, and then those are the names that all of a sudden could make or break a year. And we've written quite a few blogs on specials, and if you go back a few years, we wrote about the Citibank special, which generated $1 billion billion US dollars in 2009. So specials do have a major impact on the income. And I would say the fourth point, and that's of course predominantly on the equity side, of course, is that there were dividend cuts, and take it or leave it, there's still a huge chunk of the revenue generated by dividend related transactions. So much for the equity side. Funny enough, of course, that the government bond side actually increased revenue 8% year on year, which is substantial. Seeing that the volumes are going through those books. But that being said, on the government bond side, it was up 8%. Actually, on the corporate bond side, it was down 30%. So reasons, of course, there's still a huge chunk of demand for high quality liquid assets. So the European, US Treasury, UK gilts type of transactions, and it seems that the short sellers are reluctant to sell short into credit. Different kind of reasons, but that predominantly was the cause of the 30% drop in the government bonds over 2020.
Jeroen, just on that point, down 30% is a huge number, but as you point out, when you think about it, when you have the Fed buying everything, it's a brave trader that's going to sell into that or short into that, because there was almost a false underlying support to that market that you weren't going to bet against.
But
so I'm not,
on top of it as well, John, of course, it was not only the Fed that was buying into the credit, but it was also different governments that were bailing out certain companies. So let's say the airline industry or the tourist industry. If all of a sudden there is
governmental
influence in those transactions, then
I mean, it gives you confidence that you can go and buy it yourself as well at cheaper.
And you don't want to buy into it. No, you're right. You don't want to sell into it.
No.
Yeah, it was interesting. I was expecting that a few years ago that by now the market would be getting back to more normalized interest rates, and as a result, a lot of the corporate bonds that would be coming up to be refinanced would struggle, right? So where companies didn't have business objectives for borrowing, but they borrowed because it was cheap, bought back their stock to increase their earnings per share, that some of those companies were actually zombie companies and would have trouble. Who would have known that we'd have even lower interest rates and even more accessible funding and liquidity now? And the drive, one of the highest performing asset classes this year is high yield debt. So who would have thought that? So,
And of course, that's the reason why it's minus 30% in the securities lending revenue, because you're not selling into that market.
So for those that are interested, 7 p.m. GMT, you can tune into the whichever TV channel is taking it. You can listen to the Fed's last FOMC meeting of the year, in which they'll give a press conference, and there Roy, you may get some inclination of where they're heading, if they give anything away. But this is quite an important one, because there is a lot of speculation as to what they should be doing in terms of the asset purchasing program. It's huge. Should they be buying longer maturities? In other words, supporting the housing market to some extent. So it could be quite an interesting one to dial into. Others have put me to sleep, but this may not.
Right. So I want to thank Clive for being willing to share with us his view that he likes the idea of temporary short selling bans during periods of market disruption. And, I think even I have said, for the right market, I think that's correct. I think small markets, you kind of have to give them a buy on that. I would question whether major capital markets should really be implementing short selling bans. And we've seen, what happens when France has a short selling ban and Germany doesn't, is really a demonstrable difference in performance. And the answer to that has, on a couple of occasions, been clearly no. There's no real difference.
Yeah, true.
I want to just move on to one of the other big trends, which is ESG. And John, I know this has been a point that you've been very much focused on this past year.
Because you can't avoid it. I mean, I try and read anything that doesn't have an ESG component to it. And I think it's fair to say that the jury is back in when it comes to ESG. The number of funds that employ an ESG strategy are just through the roof. And it's going to do nothing but continue in that vein. I spoke to a fund manager I know recently who said, look, we don't talk about ESG here anymore because everything we do goes through our ESG methodology and lens. And that's not just for the funds we're investing in. It's actually, as a corporation, we think about this and how we behave. So we don't really make the distinction. And I think that's probably a trend that is clearly set to continue. And just look at the amount of press around climate change in the industries that are the most polluting and what they're trying to do about it. And even this morning, maybe it was this morning or yesterday, I can't remember. Exxon came out this week with some new targets for 2025 in terms of what I thought sounded great, emissions targets. They're finally towing the line that others have done previously to this, and they seem to be dragging their feet. And then this morning there was a critical article about this because in the detail, they were going to make a target about intensity as opposed to emissions in absolute terms. And I thought, what the hell does that mean? And I read and I realized that the intensity is measured in a different way, but ultimately, because of ExxonMobil's new drilling ambitions, they were going to be net polluters and continue to be so. So the response to their new targets they announced on Monday, I think it was, were muted. So you have to go into some more detail at times to really get a handle on what's going on, and that leads to an argument or not, a debate around, well, how do you measure something? What's the standards, and where should they come from? When it comes to securities finance, because that's where we're really interested in how this will play out. I think in the past I've kind of said, look, you don't have to worry about it because you're not making the investment decision. Your clients made that with the assets they're giving you to lend, so you shouldn't worry. But actually, I think that's now quite flippant of me in that you do have to have a view in terms of what your clients are likely to ask you to do in the future. I think there's going to be demands made on programs that maybe we haven't considered. For example, I read an article, there was a joint survey conducted by PASLA and what's the Asia Investor. And it was quite interesting in that when they asked a number of both asset owners or asset managers that had lending programs and those that didn't, the second highest response that they wanted from SEC lending was transparency over what happens to their assets. In fact, 2/3 responded in this way. And I thought, hang on, what do you mean? And what they were saying was when the asset is lent, they want complete transparency through the chain of where that asset goes as to what's happening with it. Now, my immediate response to myself was, well, you can't know that because title's passed and you don't own your asset anymore. But actually, think about that. Doesn't matter what I think. If clients in Asia are going to want to know more about that, and I agree there is absolutely no tool that can do that currently, then maybe we should be thinking about how do you address their concerns? Because if that leads to, well, I won't lend then if I can't have more transparency, because as an investor, I feel responsible for knowing how my assets are put to use. Do we have to change the structure of that transaction? And of course, you can argue that the ultimate way to solve that is tokenization, so the asset never leaves. But we're not there yet. So I found that quite interesting. So I think there'll be more restrictions in terms of maybe significant holdings where clients have we just talked about that, but I think clients will perhaps start placing more restrictions about holdings they either have significant holdings in or they're particularly sensitive about. And I think that the same is true of small cap holdings. One of the things, Roy, that really interested me the other day was listening to your podcast with Max Budra. And in that, Max says something that I hadn't ever considered, in that he was talking about hedge funds and how they approach ESG in general. And he said that maybe some hedge funds are thinking along the lines that should they be shorting for want of a better word, a bad stock in which they have no interest, because by doing so, they are expressing an economic interest in the company they're shorting, and they're also receiving revenue from that activity. Or should they be avoiding it because they wouldn't go long of it? And therefore, you had this sort of dichotomy of, should you really be benefiting from something that you don't believe in? And I don't know if you have an answer to that, Roy, but I found that really interesting. In fact, I had to stop my workout at the time.
Well, look, to me, that was one of the most interesting revelations from the podcast as well, because it was this whole idea of using hedge funds to manage the risk in the remaining part of the portfolio. And then do you then extend it further and benefit from the views that you hold strongly? And there is I thought it was fascinating as well. Should I really be benefiting from something I don't believe in? That's one argument. The other argument is I really don't believe in this, so I really have an interest in seeing old brown industries be downtrodden, if you will, and sort of contributing to that. So I think it's an interesting perspective. John, Mike has pointed out that transparency is available through DLT. And guys, I don't want anyone to get too excited about this, because the reality is that it's still about the economic interest. The customer, I don't think that these beneficial owners that are concerned about where their assets go, I don't think they care so much about the chain as they do about the end use for that asset. And unless you also then tokenize the exchanges and you see what the rest of the trading strategy is around that, all you could really be certain of is that there was a short sale, period. And you wouldn't know whether that was an arbitrage or an expressed view or a short-term high-frequency trade, like a statistical arbitrage. Just very, So I think that's why I think transparency is sort of a red herring. And I'm really interested in digging more into that PASLA survey because there were so many respondents that weren't lending. So if they're not lending today and they say, well, we're not going to lend if we don't get greater transparency, that's unfortunate. But I don't know that has an impact on the market. If it's the 1/3 that is lending that says, unless we get better transparency, we're going to stop lending, that's a different issue. So I think there's lots of layers to this.
It's clearly a very thorny issue to try and solve for, because unless you change the way that the transaction is structured, the borrower has no rhyme or reason to tell you.
Yeah. Okay. So listen, the other point. Sorry, John.
And as Mike points out, the transparency through DLT only tells you the ownership, as you say, Roy. It doesn't tell you the driver.
Yeah.
And if Asian clients want the drivers as to why the asset's being used, that's going to slightly change the way we go about this, which I think could be interesting. I mean, just to finish up on ESG in general, I think we understand the idea of recalling stock, and I think the tools to do that probably could improve, because I think clients are going to have to explain themselves in far more transparent ways as to exactly the actions they took, and that will roll downhill to agent lenders that have to, you have to recall and you actually have to settle it. Now, the last thing you want is to lend a stock, clients insisting on recalling it, and you fail back to them, because that's going to open up a whole can of worms that could actually end up becoming problematic. When it comes to, I think the subject that's probably more solvable is the idea of collateral should reflect the ESG policies of the underlying fund or the client. Eliminate negatively screening for ISIN or SIC codes is one way of going about it. But it isn't sustainable, because even a tri-party agent can't do that for hundreds of clients that it has if it's going to be a manual process. So I'm pretty sure that there'll be more tools to address that. But it comes back, and it always does come back to where is the standards going to come from? And actually, it's probably companies themselves that are much better at reporting their own measures than perhaps the third party is. But you won't see standards in the ESG space for a long time. It should be driven by countries, governments, regulators, I think. But they have to agree. I mean, the EU Commission is all over this. Less so in the US, actually, surprisingly. But that's a long way off. But in the meantime, there are groups and bodies collaborating to come up with something that all can measure, which is reasonable, because if you're a corporation trying to do the right thing, you need to know what standards you're working towards. So I think there's a lot to come out of that. Lastly, on this point, not to labor it, but I found it really interesting that the Norwegian Sovereign Wealth Fund came out recently and said that they're going to announce 5 days before every meeting on 12,000 stocks exactly how they're going to vote, and they're going to make it public. If they're going to do it, others will follow.
Right. So, look, I think you've talked about 1,000 different things in there, but some of them almost you would think that was actually planned, but it wasn't. Because, look, I agree with many of the points that you've been talking about. The most fundamental issue here, I think, is the issue of standards. And I couldn't agree more that while you might have a European standard, so I could see that the EU might come up with standards and individual countries might come up with their own standards, but each of these will have skews based on whatever their perspective is, whether it's an environmental agenda or a social agenda. And so it's unlikely that you come up with a harmonious one. And so I think the securities lending market is really challenged with the objective of saying, do we wait? And do we just go, oh, well, we'll get around to it when everything else gets sorted out? Or do we take pro-action? And so, to me, this is an inclusive issue. And you will have heard me talk about it a couple of weeks ago when there was a question from the audience. I think it was I think it might have been Drew from Securities Finance Times. But it was about global principles for sustainable securities lending. And actually today, there's actually a press release and an invitation for people to consult and provide feedback on it. So I'm just going to share screens. Hopefully this works, because I haven't really done this yet. Hopefully you guys can now see the GPSSL page. John, Drew?
Yeah.
Not yet?
Oh, sorry. No, hang on. I didn't have it turned on. I can see it now.
Okay, cool. So look, you can see the website, which is just GPSSL, but this fanciful globe looks at the issues. And what GPSSL is inviting really the widest community to participate in and comment on is a series of principles. And look, one of the main issues and the formation of GPSSL is that there are so many stakeholders in the securities finance business. There are the investors, there are the intermediaries, there's the end traders, but there's also regulators, there's governance oversight, there's trustees, right? There's this huge community of interest that's there. Johan, thanks for your comment there that you can't see the screen. So what I'll do is I'll post up the page so you can look at it at your leisure. So hopefully the website is there. Look, it's not, apparently a lot of people are saying they can't see the screen.
Yeah, I saw it for a second, then it went off again.
Okay, well, look, I'll stop that. We'll go back to me, and you'll be able to see it there. But look, what we want is from now until the end of January, just go to that website that's actually on the screen now, gpsssl.org. It's a really straightforward listing of the principles on issues like alignment, inclusion, diversity, transparency, which we've talked about a lot today, collateral, which John has mentioned, and I think is a key issue, short selling. And many of you hopefully have seen that one of the working groups that was announced earlier this week was a work stream from GPSSL, which will be looking at short investing and long investing, and is co-chaired by three of the leading lights in short selling activism, Carson Block of Muddy Waters, Gabriel Greco from Quintessential Capital Management, and John Hempton from Bronte Capital, real leaders of the industry, and they're running this work stream, which will really try to help bring out some of the arguments as to how short selling and the long side of investing, how there's asymmetry, but also how it contributes to better governance. Remember, short sellers are the ones that found Wirecard and NMC Health and continue to do so, rather than it being driven by long investors, regulators, or auditors. So short selling is a critical part. Taxation, fundamental to everyone, and there's lawsuits in a number of jurisdictions. So we need to be very clear that we are heading in a direction that makes this a better marketplace than where it has been in the past. Voting, we've talked about it today, but also really fundamental. And all of these issues, with the final one being innovation and digitalization, these aren't just sort of platitudes. There are action steps in there. We'd love your feedback on it. Are there things that are missing? Are there things that are being added to it? And also, if you want to engage in the discussion, I'd invite you to message Radek Stek, who is listed on that page. Contact him directly. Of course, I'm always happy to talk to you, but really, you need to go to him. It's a community interest corporation, which means by definition, it has to be open and inclusive. So this is your chance to participate and influence the direction of ESG on how it affects investments and your role within that community. So Martin, hopefully that will be something that's attractive for you and the widest community. So thanks for your comment, Martin. Look, a couple minutes to go. If anyone has any last questions, can I just ask maybe John and Jeroen, while we're waiting for any last minute questions to come in, what's your big takeaway from 2020? It could be a personal revelation. It could be work related. What's your thing?
Should I start, John?
Yes, please.
All right. I would say it's the entire Wirecard saga. It's been such a story that from absolute lawsuits coming in from the BaFin to people that are short selling, from almost like spy-like intrusion to people that were short in the stock, to the actual outcome, and even to the tragic death of one of its employees. All in all, a Netflix series waiting to happen.
Yeah, and for those of you that are interested, Jeroen and I are doing a podcast which will come out tomorrow, and we'll be talking about some of the key trades from his trading review series, which has been so well received this year by our readers. Thanks, Jeroen. John, over to you.
Well, the thing I learned this year was don't short the S&P 500. So even on a paper basis, which you guys know about, I tried to have a paper short twice Once I was right for 2 days, and then I got completely blown out. I was trying. Then I worked out the fundamentals of what was going on this year compared to what went on 12 years ago, and it's very different. And I think, if anything, look, I'm not surprised that securities lending revenue is down when you have stock markets behaving like this. But the fundamental reasons for this were very different, and I think it means that now that we have a vaccine with us, 2021 could be a very different year on a much more positive note.
Okay, well, that's quite an interesting one, because my blog post talking about the death of short selling really makes me wonder whether we're actually at the point of capitulation, which means that short sellers are giving up taking short positions as markets are peaking around the world, in my opinion, fueled by government liquidity, but not everyone agrees with that. In fact, many people disagree. I think that securities lending might have quite a good year next year, and I think that there will be a lot of companies that have been rising with the tide rather than on their own merit. So we'll see who's wearing the bathing suits.
I think sorry,
go
I
ahead,
was going to
John.
say the asset class to watch next year in securities lending is corporate debt.
Yeah,
I think that would be very interesting and lucrative.
As I said, high yield debt has had 2 peaks this year, and the spreads are stunningly thin, given the risk relative to high quality corporate debt. So I agree with that. That's also ETFs. So again, if you have ETFs, I would definitely be making certain that they're in lending programs wherever possible. Listen, I think we've come up to just over an hour. So thanks to everyone that's actually stayed there. I'd like to thank my colleagues, John and Jeroen, who've been great to work with this year. Zafira, who hasn't been able to be on one of our live events yet, but we'll get her on yet. She's running our training stuff. Raymond Blockland, who's our podcast engineer. So he's doing some work for us there, and Julian Eyre, who we are working with, and of course Andy Stevenson, who is kind of our guiding light on many issues, and quite an influential people. So thanks to all of them, but mostly thanks to you who've looked at our blog posts, taken our courses, watching the live webinars. I really appreciate everything that you do. We may or may not do one of these next week. If we do, it will be more of a fun one rather than a work-related one. So watch this space to see if we advertise again. Thanks, everyone. Appreciate your time and your focus. And thanks very much. All the best over the festive season.
All right. Thank you all.
Bye.
Bye-bye.
Thank you.
Thanks, everyone. Bye.
Bye.